Friends, thank you for being here today. I want you to sit with a single thought before we go any further. Toronto, one of the most expensive cities on the face of this earth, a skyline crowded with glass towers, a market that financial commentators spent an entire decade calling unstoppable, a city where the accepted wisdom was simple: buy a condo, collect rent, and wait to become wealthy. That was the promise. That was the architecture of the dream. And today I am going to show you with mathematical precision why that architecture is not just cracking. It has already begun to implode. What if I told you that the very investors who bought into Toronto's property market are not landlords at all? What if the more accurate term for them, the term that the data demands, is philanthropists? Because right now, 81% of investors who hold a mortgage on a newly completed condo in Toronto are losing money every single month. Not a little money. Not an inconvenient amount. We are talking about an average of $600 a month bleeding out of their accounts silently, automatically, while they sleep. The passive income dream has geometrically inverted into a passive expense nightmare. And no one in the mainstream conversation is saying it plainly enough. This is not a market correction. Do not let anyone call it that. A correction implies a system seeking equilibrium, a pendulum returning to center. What is unfolding in Toronto's condo market right now is something structurally different. It is a negative carry trap snapping shut on hundreds of thousands of ordinary Canadians who were told repeatedly, aggressively, by banks, by developers, by television personalities that real estate only goes up. That leverage was wisdom. That debt was the ladder. The numbers I am about to share with you are not projections. They are not forecasts dressed in probabilistic language. They are reported data from Q3 2025, and they describe a fault line so severe that once you understand the mechanics underneath it, you will never look at a glass condo tower the same way again. New condo sales in Toronto in the third quarter of 2025 collapsed to levels not seen since 1990, in a city absorbing record immigration, in a city with some of the most aggressive population growth on the continent. Only 319 new units were sold in an entire quarter. 319. The market did not slow down. It did not pull back. It flatlined like a patient whose vital signs have stopped registering. And sitting above that flat line, unsold and growing heavier by the week, is an inventory glut of biblical proportions. At the current pace of sales, it would take 58 months to absorb the existing pre-construction inventory. 58 months. Nearly 5 years. I want you to feel the weight of that figure. In a healthy real estate market, 6 months of supply is the benchmark. 6 months. Toronto is sitting at 58. That is not a statistic you can explain with interest rates. That is not a problem that a quarter point cut from the Bank of Canada is going to resolve. That is a structural break. And here is the thesis that everything else in today's conversation will build upon. There is no mathematical path, none, for most of these investors to wait this out. The money is running out too fast. The exit doors are too narrow. And the forces that are about to converge on this market are not moving slowly. They are already in motion. This is not a singular inevitability approaching from the horizon. It has already arrived. We are simply watching it unfold in slow motion, the way a building does not collapse instantaneously, but instead begins with a quiet, almost imperceptible lean. Let me take you back, because this crisis, like all crises, did not begin last quarter. It did not begin with the Bank of Canada's rate decisions. To understand the true weight of what is happening, you have to understand how the scaffolding was built. Between 2019 and 2022, something extraordinary happened in Toronto's real estate market. Interest rates were at the floor. The Bank of Canada's overnight rate sat effectively at near zero, and the government, in an attempt to stimulate a pandemic-shocked economy, flooded the system with liquidity. And into that environment of cheap money and suppressed fear, developers launched a product that seemed, on the surface, entirely rational: the pre-construction condo. Here is how the mechanism worked. A developer files plans for a tower. The tower does not exist yet. It is paper, architecture drawings, a rendering on a billboard. They begin selling units in this imaginary building to investors. The investor puts down a deposit, often 5%, and signs a contract to close the mortgage in 3 to 5 years when the building is completed. The investor's calculation was simple: buy at today's price, close in 3 years, by which time the market will have appreciated significantly, and either flip the unit for a profit or hold it as a cash-flowing rental asset. It was, by design, an arbitrage on time. Think of it like this. Imagine someone offered you a contract to buy a car for $30,000 to be delivered in 3 years. You sign it today. Between signing and delivery, the market for that car collapses. The same car now sells for $22,000 on any used lot. You are legally obligated to pay $30,000 for something worth $22,000. You cannot walk away. The developer will sue you and keep your deposit. That is the pre-construction trap, and it is not a hypothetical. It is the documented reality for a staggering number of Torontonians who are closing on units right now in 2025. The buildings they bought in 2019, 2020, 2021, they are finishing. The cranes are coming down. The keys are being handed over. And the investors who were counting on appreciation are instead confronting a terrifying mathematics. Resale prices for condos in Toronto now sit at approximately $903 per square foot. The investors who signed pre-construction agreements paid over $1,200 per square foot. That $300 gap per square foot is not a paper loss sitting somewhere on a spreadsheet. That is real capital that evaporated. Buyers in these buildings are underwater the moment they receive their keys. In some cases, they are being asked to come up with hundreds of thousands of dollars in additional cash just to close the transaction. And if they cannot, they walk away, forfeit their deposit, and face litigation. But here is where the system reveals its most crucial secret, and this is where I need you to pay very close attention, because this is not just a story about individual investors making bad bets. This is where the rot spreads. When a distressed investor cannot get financing from a traditional bank, and increasingly they cannot because the appraisal comes in below the purchase price and the bank will not lend on an underwater asset, they do not simply give up. They go looking. They find what the industry calls a private lender, a shadow bank. And I need you to understand what a shadow bank actually is in the Canadian context, because it is not what you picture when you hear the word bank. These are not institutions with marble lobbies and risk departments. These are often individuals, your neighbor, a retired engineer, a small business owner, people who have significant equity built up in their homes through the previous decade of appreciation. They take out a home equity line of credit on their own home, and they lend that money out to distressed condo investors at 10, 12, sometimes 15% interest. They are playing the role of lender with their own home as the collateral. And I want you to feel the architecture of what I just described, a chain, an investor who cannot pay, borrowing from a person who borrowed against their house to lend, who is depending on that repayment to service their own debt. It is a 200-page IOU written in the worst possible chain of obligation. And when the investor defaults, not if when, the private lender does not simply absorb a loss. The private lender faces a call on their own home equity. The chain does not break at one link, it unwinds. This is the mechanism that the banks say they are insulated from. This is the firewall they point to when they report their stress-tested balance sheets and their conservative loan-to-value ratios. The big five Canadian banks, Royal Bank, TD, Scotiabank, BMO, CIBC, will tell you their direct exposure to this distressed condo inventory is manageable. And technically, in isolation, they may be right, but what no one in the mainstream financial press is asking with sufficient urgency is this: what is the Big Five's exposure to the private lenders? Because those shadow banking institutions, those chains of individual lenders with leveraged home equity, are not floating freely. They are woven into the same fabric. The banks hold the HELOCs that are funding the private lenders. The banks hold the construction loans on the developments facing receivership. The firewall is not a wall, it is a membrane, and membranes under sufficient pressure rupture. This leads us to the system's most crucial secret, which we will explore in full as we move deeper into this analysis. But before we get there, before I show you the specific evidence that this contagion is not theoretical, that it is already producing casualties right now in the Canadian market, I need you to hold one thought. The question is never whether a system built on negative carry and impossible mathematics can sustain itself. The answer to that question is always no. The only question, the only variable, is when. And the data from Q3 2025 is telling us that when is not coming. When has arrived. Let me show you the canaries, because every collapse in financial history has them. They are always there, singing their warnings in the data, in the obscure filings, in the numbers that the headline writers do not think are dramatic enough to put on the front page. The canaries in the Toronto condo market are not subtle, they are not hiding, they are loud, they are multiplying, and if you know what to listen for, the sound they are making right now is deafening. The trigger moment, the event that shifted this situation from serious concern to structural emergency, came in the third quarter of 2025. Completed unsold inventory in Toronto did not just rise. It did not tick up modestly in the way that analysts use careful language to describe. It exploded. Completed unsold condo inventory jumped 102% year over year. In a single year, the number of finished, built, ready to occupy units sitting on the market with no buyer doubled, 102%. In a city where the gospel for a decade was that supply was the problem, that there were never enough units, that anyone lucky enough to own a piece of Toronto real estate was sitting on the most reliably appreciating asset in the country. I want you to understand what a completed unsold unit means in practice. It is not a pre-construction contract sitting in a drawer. It is a physical building. It is a developer who has already spent the capital, the construction loans, the labor costs, the material costs, the carrying costs, and is now sitting on a finished product that the market is refusing to absorb. Every day that unit sits empty, the developer is paying interest on the construction financing. These are not patient, deep-pocketed institutions willing to wait years for the market to recover. These are leveraged operators with debt service schedules and covenant requirements. When they cannot sell and cannot service their debt, the lender moves in. The project goes into receivership. And a receivership sale is not a negotiation. It is not a motivated seller accepting a small discount. A receivership sale is a court-ordered liquidation at whatever price the market will bear on a compressed timeline. It is distressed inventory entering the market at fire sale pricing. And when that happens at scale, when dozens of projects simultaneously hit receivership, the pricing does not drag the market down modestly. It resets the floor. Every other condo seller in the city is now competing against assets being sold at restructuring prices by courts with no emotional attachment to the outcome. This is the mechanism. This is how the spiral accelerates. But let me give you the names. Let me give you the forensic evidence, because this is not a theoretical model. This is already happening. The first canary, the cancellation wave. In the first 9 months of 2025 alone, 18 pre-construction projects representing more than 4,000 residential units were cancelled outright. The developers did not push the timeline. They did not pause. They cancelled. They looked at the math, at the sales numbers, at the financing environment, and made the decision that it was less catastrophic to stop than to continue. Think about what a cancellation means to the buyers who put deposits into those projects. Years of waiting, capital locked up, earning nothing, now being returned, if the developer has the funds to return it, which is not always guaranteed. Think about what a wave of cancellations does to the construction trades. Thousands of workers whose jobs simply cease to exist because the project funding evaporated before the first foundation was poured. Even the developers, the people who built their entire business model on the premise of Toronto's endless appreciation, do not see a future in the near term. When the people building the buildings stop building, that is not a sentiment indicator. That is a structural signal. The second canary, the assessment gap. And this one I want you to sit with, because it is the clearest expression of the bubble's true size. Resale condos in Toronto are currently trading at approximately $903 per square foot. That is the market price that a willing buyer is paying a willing seller in an arm's length transaction today. Pre-construction buyers in the 2019 to 2022 window paid over $1,200 per square foot. In some of the more aggressively marketed downtown projects, the prices were even higher. That gap, $300 per square foot, is not an accounting abstraction. On a 700 square foot condo that represents $210,000 of value that simply does not exist, it was never real. It was a number on a contract signed in a world of 2% interest rates and infinite optimism. And now the building is finished, and the market is telling the buyer with complete mathematical indifference that the asset they purchased for $840,000 is worth $630,000. The air in the bubble is not hissing out slowly. It is hissing out at $300 per square foot, and the buyers are underwater before they finish unpacking. The third canary is the one that should disturb you most, because it is the one that tells you where we are in the cycle, when credit becomes inaccessible through legitimate channels, when the math on a transaction no longer works under any honest representation of the borrower's finances, when the only path to closing is to misrepresent. That is when synthetic fraud appears, and synthetic fraud is rising in the Canadian mortgage market right now. Desperate borrowers fabricating income documentation, inflating employment records, engineering financial statements to satisfy lenders who are themselves under pressure to deploy capital. This is the hallmark of a late-stage credit cycle. It happened in the United States in 2005 and 2006. The liar loans, the ninja loans, no income, no job, no assets. The terminology was different. The mechanism is identical. Synthetic fraud is not a crime statistic. In the context of credit cycle analysis, it is a diagnostic. It tells you that the legitimate demand has been exhausted, that the people who can honestly qualify have already bought, that what remains in the buyer pool is desperation, people who want to close, who need to close, whose entire financial plan depends on closing, and who are willing to lie to the underwriter to make it happen. And when those loans begin to perform, or rather fail to perform, the losses crystallize at the lender level. Now let me show you the encirclement, because the most psychologically devastating feature of this crisis is not the scale of the losses. It is the absence of a good option. The trap is complete. The exits are welded shut. And I want to walk you through exactly why. If you are a condo investor in Toronto today, if you are one of the 81% bleeding $600 a month in negative cash flow, what are your choices? You can sell. You list the unit at market. You accept a price that is 12% below what you paid, which on a downtown condo likely means absorbing a loss of $80,000, $100,000, $150,000. You take that loss, you close your position, and you stop the bleeding. That is, on paper, the rational financial decision. Your first loss is your best loss. But here is the reality. You cannot sell quickly because you are not the only seller. You are one of thousands. The inventory that has flooded this market means that your listing is competing against hundreds of identical units in identical towers, all of them owned by investors with the same desperation, all of them slowly lowering their asking prices as the weeks turn into months and the carrying costs continue to accumulate. So the sell now option is real, but it is slow, it is expensive, and every week you wait while the listing sits unsold, you are paying another $600 for the privilege of losing $150,000. You can hold, you keep the unit, you absorb the negative cash flow, you tell yourself that the market will recover, that rates will fall, that immigration will drive demand, that Toronto is a world-class city, and world-class cities do not stay down. And this argument is not entirely irrational. Over a long enough time horizon, real estate in major urban centers does tend to appreciate, but we are not talking about a long enough time horizon. We are talking about a mortgage renewal cliff that is arriving not in 5 years, but now. A record number of Canadian mortgages are renewing in late 2025 and into 2026, and investors who originally financed at 2% and are now facing renewals at 4 or 5% are not dealing with a theoretical payment shock. The payment shock is arriving in their inbox right now in the form of renewal offers from their banks. The math of holding is not the math of patience. It is the math of compounding loss. Every month of negative carry adds to the total cost basis of a position that is simultaneously declining in value. You are not waiting for a recovery. You are paying to wait for a recovery that may be a decade away. You can rent it out. You can become the landlord you were always theoretically supposed to be and find a tenant who will pay market rent. Except market rent in Toronto, even with the recent immigration-driven demand, does not come close to covering a mortgage renewed at current rates, plus the maintenance fees, which in many newer condo buildings have risen dramatically from the developers' optimistic pro forma projections. The negative carry does not disappear because there is a tenant. It simply becomes slightly less severe. You are still bleeding. You are bleeding more slowly, but now you have added a new layer of risk because Ontario's residential tenancy laws are among the most tenant protective in North America. If your tenant stops paying for any reason in any circumstance, the process of legally removing them takes, in many documented cases, more than a year. 12 months of a non-paying tenant while you continue to service the mortgage is not a landlord horror story. It is a common outcome in the current legal environment. Every door you open leads to the same room. Sell and absorb a massive loss in a market with no liquidity. Hold and pay monthly while the position deteriorates. Rent and pray that your tenant continues to pay while you barely break even on a good month. The liquidity tide is going out, and we are finding out one by one who has been swimming naked. And here is what I want to make absolutely clear before we move to the final phase of this analysis. The question of whether this crisis stays contained to the condo market, whether it is a problem for investors who made bad bets and must simply live with the consequences, is not an academic question. It is the central question. And the data, the mechanics, the structure of the shadow banking system I described earlier all point to the same answer. This does not stay contained. The construction sector is already registering the early tremors. As projects cancel, as receiverships mount, as developers stop breaking ground on new towers, the trades begin to lose work. The concrete crews, the electricians, the framers, the finishers, these are not abstract economic actors. They are households. They are mortgage payers. They are consumer spending. When construction employment in a city like Toronto contracts sharply, the economic drag does not stop at the job site. It moves through the economy like a current through water, touching every business that those workers patronize, every landlord collecting their rent, every bank holding their mortgage. The housing crash is becoming an employment crash. The employment crash becomes a demand collapse, and the demand collapse feeds back into the housing market, removing even more of the marginal buyers that the system depends on to function, vanishing in real time. Friends, let me now show you the convergence, because what I have walked you through so far, the negative carry trap, the pre-construction collapse, the shadow banking chain, the canaries singing in the data, none of these forces are operating in isolation. That is the critical misunderstanding that most analysis of this situation makes. Commentators look at each individual component and conclude that it is manageable. The Bank of Canada can cut rates. The government can introduce buyer incentives. Developers can slow construction starts to reduce supply. Each intervention viewed in isolation sounds plausible. Each one applied to a single problem might even work. But we are not facing a single problem. We are facing a trifecta. three distinct forces hitting the same structure simultaneously, and the structure was not built to withstand even one of them at full force, let alone all three arriving together. The first force is the Mortgage Renewal Cliff. This is not a forecast. It is a scheduled event locked into the calendar with the precision of a court date. A record volume of Canadian mortgages, including a disproportionate share of investor mortgages on condo units, are coming up for renewal in the period spanning late 2025 through 2026. These are mortgages that were originated at the floor of the rate cycle, when the Bank of Canada's overnight rate sat near zero and 5-year fixed rates were available at 2% or below. The investors who signed those agreements did not model for the world we now inhabit. They modeled for the world that existed when they signed, a world of cheap money, rising rents, and appreciating asset values. That world is gone. The renewal offers arriving in their inboxes are at 4, 4.5%, 5%. The monthly payment shock is not marginal. On a mortgage of $500,000, the difference between a 2% rate and a 5% rate is approximately $900 per month. Added to the $600 in negative carry that many of these investors are already absorbing, the math becomes not just uncomfortable, but structurally impossible. You cannot hold a position that is costing you $1,500 a month in a market with no buyers, declining values, and no credible timeline for recovery. The renewal cliff is not a wall that some investors will hit. It is a wall the entire cohort hits in waves month after month through 2026. And each wave that hits produces another surge of distressed listings, another wave of sellers competing in a market already glutted with inventory, another downward pull on prices that makes the position of the investors who have not yet renewed even more precarious. The second force is the investor exodus, the marginal buyer, the person whose decision to enter or exit the market sets prices at the margin. In the Toronto condo market for the last decade was the small investor, the individual who read about real estate wealth, attended a seminar, watched the YouTube channels, and concluded that leveraged property ownership was the fastest path to financial independence. That buyer has not become cautious. That buyer has not become skeptical. That buyer has disappeared. Capital that once flowed reflexively into pre-construction condos is now moving into guaranteed investment certificates, paying 4 and 5% with zero risk, or into US equity markets, or simply staying in cash. The psychological architecture that supported a decade of condo speculation, the unshakable belief that Toronto real estate was a one-way elevator, has cracked. And belief in asset markets is not a soft variable. It is the load-bearing wall. When it goes, everything that was resting on it goes with it. The third force is the employment contraction in construction. I touched on this in the previous phase, but I want to make the mechanics explicit because this is the force that transforms a real estate crisis into a broader economic crisis. And it is the force that the most optimistic analyses consistently underestimate. Construction and real estate adjacent employment represents a significant share of the Canadian economy. And within that, Toronto's condo construction boom of the last decade was an enormous employer. Architects, engineers, project managers, skilled tradespeople, material suppliers, equipment operators, an entire economic ecosystem built around the assumption of perpetual development. As cancellations mount, as receiverships accumulate, as developers look at 58 months of unsold inventory and make the rational decision to stop adding to it, that ecosystem does not gradually downshift. It contracts sharply. Jobs that existed on Thursday do not exist on Friday. Contracts are terminated. Suppliers are not paid. And the workers who lose those jobs are not, in most cases, people with deep financial reserves. They are people with mortgages of their own. They are people with car payments and rent obligations and children in school. When they stop working, they stop spending. And when enough of them stop spending simultaneously, the consumer economy feels it. Three forces: the mortgage cliff, the investor exodus, and the employment contraction. Each one alone would be a serious problem requiring serious policy response. Together, arriving simultaneously on a market already weakened by 12% price declines and 102% surge in unsold inventory, they do not add, they compound. And compounding is the most dangerous force in finance, precisely because it is so easy to underestimate until it is far too late to respond. Now, I need to talk to you about something that has nothing to do with interest rates or inventory figures. I need to talk to you about your mind. Because the greatest threat facing anyone watching this right now is not the data. The data is clear. The greatest threat is the way human beings are hardwired to process information that contradicts a worldview they have held for years. There is a concept in behavioral psychology called normalcy bias. It is the deeply embedded cognitive tendency to believe that tomorrow will look like yesterday, that the systems we have depended on will continue to function the way they have always functioned, that the exceptional will not become the norm. And it is not a character flaw. It is not a failure of intelligence. It is a feature of the human brain installed by evolution, because in most environments throughout human history, stability was the rule and catastrophe was the exception. Normalcy bias kept our ancestors from panicking unnecessarily at every fluctuation in their environment. But in a financial crisis, normalcy bias is lethal. It is the psychological mechanism that causes investors to watch a position deteriorate for months, absorbing loss after loss, because each individual month of loss feels like an anomaly rather than a pattern. It is why people hold on. It is why they wait. It is why they tell themselves that the next Bank of Canada rate decision, the next quarter's data, the next spring selling season will be the one that turns things around. And underneath normalcy bias runs a second, equally dangerous phenomenon that I want you to understand. It is called the liquidity illusion. And it is perhaps the most elegant trap in all of personal finance. Your condo is on the books at $600,000. You know this because Zillow says so, because your neighbor sold for that price 18 months ago, because the bank appraised it at that figure when you renewed. It feels real. It registers in your mind as wealth, as a number that belongs to you, that you can access, that you can deploy. But here is the reality that the liquidity illusion conceals. An asset is worth what someone will pay for it on the day you need to sell it in the market conditions that exist at that moment. If there are no buyers, or if the buyers that do exist are offering 30% below your asking price, your $600,000 condo is not worth $600,000. It is worth what the market will pay. And in a market with 58 months of supply, with distressed receivership inventory competing against your listing, with investors fleeing and first-time buyers unable to qualify, the number the market is willing to pay and the number on your statement are not the same number. You are not a millionaire on paper. You are a creditor in a system that is struggling to honor its obligations. And the longer the liquidity illusion persists, the longer investors hold their positions, waiting for a valuation that exists only on paper to become real, the deeper the eventual reckoning becomes. This is not a conspiracy. It is not the result of malice or incompetence at the Bank of Canada or in the offices of the developers. It is the stated, documented mathematical outcome of a credit cycle that was allowed to run farther and faster than the underlying fundamentals could support. The simple household logic that borrowed money invested in physical property is always safe because they are not making more land does not apply in a market where the carrying costs have risen above the income the asset can generate, where the exit requires a buyer who does not exist, and where the collateral chain connecting individual investors to shadow lenders to chartered banks is stretched to its structural limit. So let me ask you the question directly. The question that cuts through all of the noise, all of the optimistic commentary, all of the "it's different here" arguments that every overextended market produces in its final phase. Do you own a real asset, or do you own a claim on an asset? A claim that depends on a functioning market, an accessible buyer, and a banking system willing to extend credit, all of which are deteriorating simultaneously. This is the binary, and I am not presenting it to create panic. I am presenting it because clarity at this stage is the only currency that matters. The investors who will navigate what is coming are not necessarily the wealthiest or the most sophisticated. They are the ones willing to see the situation as it is, rather than as they wish it to be. They are the ones willing to take the first loss, which in every documented market cycle is the best loss, rather than wait for conditions that may not return within a planning horizon that matters to them. The condo investor who accepts a $100,000 loss today and exits with capital preserved is in an incomparably better position than the investor who absorbs $600 a month for 18 more months, watches the receivership sales reprice the floor of the market, and exits 2 years from now having paid carrying costs and sold into a market 20% lower than today's already depressed prices. The arithmetic of avoidance is always more expensive than the arithmetic of acceptance. And for those watching this who are not directly exposed to Toronto's condo market, who perhaps own property elsewhere or who hold their savings in financial assets, the lesson is the same. Because the shadow banking contagion I have described does not respect municipal boundaries. The private lenders holding leveraged exposure to distressed Toronto condos are not a population confined to the city. They are Canadians from coast to coast who deployed their home equity into what looked, at the time, like a sensible income-generating investment. When those chains begin to break, and the data tells us that process is already underway, the ripple moves outward. It moves through the private lending network. It moves through the chartered banks who hold the HELOCs that are funding the private lenders. It moves through the consumer economy that depends on the confidence and spending power of a middle class that is right now quietly discovering that the wealth it believed it had accumulated over the last decade was not real wealth. It was a number on a statement in a market that is no longer liquid. There are assets that preserve value through precisely this kind of reset. Assets that do not depend on a buyer's access to credit to establish their worth. Assets that have, throughout every credit cycle in recorded history, served as the ballast against paper wealth dissolution. I am not telling you to make a speculative bet. I am telling you that the choice between holding a cash-flowing liquid hard asset and holding a negative carry illiquid depreciating liability is not a complex financial decision. It is a survival decision. It is the decision between stepping out of the line of fire before the volley or standing in place and hoping that this time somehow the mathematics of the cycle will bend in your favor. They will not bend. Mathematics does not negotiate, and the window for making a deliberate strategic decision rather than a panicked reactive one is measured not in years at this point, but in the time between now and the next wave of mortgage renewals, the next wave of receivership filings, the next downward repricing of the market floor. History favors the prepared. It has always favored the prepared. And the document of every financial crisis, from every city and every country that has lived through a credit cycle implosion, says the same thing in the same language. Those who saw it clearly, who resisted the normalcy bias, who accepted the loss before the loss accepted them, they were the ones who had something left when the cycle turned. The window for preparation is closing, not tomorrow, not next year. It is closing now in real time, one receivership filing and one mortgage renewal letter at a time. Friends, you have the data, you have the mechanics, you have the pattern. What you do with it is the only variable still in your control.